Now, Fed Chair Jerome Powell made a statement saying that the time for moderating the pace of rate increases may come as soon as the December meeting. Where do you think that the Fed goes from here?
Well, here's my take on that. The way your question was put to me tells me that the public pretty much across the board heard what they wanted to hear from the Fed chairman when he spoke. I believe it was 2 weeks ago, Wednesday, at a conference in Washington, D.C. And in fact, he did say that they effectively want to slow down the amount of each interest rate hike. Of course, if you think about it, we've had 4 consecutive rate hikes of 75 basis points each, 0.75%. In March of this year, we saw the Federal Reserve for the first time since 2018 raise rates, and they raised by 0.25%. Following month, they went to 0.5%. And then all of the FOMC meetings following that were 0.75%. So what he's saying is that we're going to reduce that 0.75% down to 0.5% most likely. That he said it would be appropriate. But he also said that it would take longer to reach their objective by doing that. So he acknowledged that inflation is persistent. It is sticky. It's still with us. It is coming down. Last reading on the CPI was 7.7% compared to June, which was 9.1%. You can see that inflation is slowly ratcheting down. In certain sectors, food costs are still exceedingly high. Gas has come down a little bit. So energy costs remain elevated. And so the key takeaway I got from all of the statements he made is while they're going to reduce the amount or pace of rate hikes, they're going to have a sustained move, and we're probably going to see interest rate hikes and then have it maintain at that level, that high level, throughout next year, 2023, and possibly even into 2024. So because of that, I take that with a big grain of salt. In other words, they're going to reduce it, but they're going to keep raising rates to whatever they need to. And right now, it is assumed that the minimum target is 5%. Fed funds rate are 3.75% to 4% now. So that means that they've still got a little ways to go, and then they're going to leave it there. Their target is 2%, and they're looking at what's called the PCE. There's 2 basic ways that you look at inflation. The CPI, Consumer Price Index, is different than the PCE in that the PCE that they look at strips out food costs and energy costs. And the 3 primary inflationary items that are worrisome are housing, food, and energy. So 2 of the 3 get stripped out. And the reason they do that is they can't control that. Now, they can control the real estate market, and they do that by raising rates, and it makes it harder for people to obtain mortgages, but they can't control energy, and they certainly can't control the cost of food production. And so that's what's worrisome to me. I think that they're actually bringing inflationary pressures down. They are. We see that in the data. But the Fed wants to get inflation at 2%. And currently it's at about 5% if you look at the PCE, which strips out energy and food, because once you add those back in, you're back to 7.7, which is what the CPI is at.
So hypothetically, what do you think will happen if they raise interest rates to the 5% level, but inflation remains high? Where do you think the Fed will go?
They'll keep it there longer and then possibly even take it above. If you look historically at times in which the U.S. had exceedingly high levels of inflation, they typically raise the interest rates above the level of inflation to bring it down. The Fed hasn't done that. And it was hard for them to do that because they started at 0. In other words, typically when you have inflation starting to rear its head, you already have interest rates that are what we call normal rates, which is 2 to 3%. And so to get it above a certain level is not as hard as when you're starting from 0. You've got 2 extra percent to account for. In other words, if inflation doesn't come down once they raise rates to 5%, they're going to keep it elevated until it does come down. Though there's a lag time between raising rates and when we see the effect in the economy. The other thing that you really have to be concerned about is their objective is to contract our economy. That means a lower GDP, and the definition of a recession is two quarters in which you've had the GDP come down, and we've already seen that happen. And so by definition, what the Fed does when they bring down inflation is contract the economy, and contracting the economy is what causes a recession. So what that means is that it's highly unlikely that a soft landing, as Chairman Powell puts it, in other words, raising rates without a dramatic impact, is a pipe dream at this point. It's not going to happen. I believe we will have a recession. The question is, will it be mild or will it be deep or somewhere in the middle? And so that's what economists are trying to ascertain right now.